The difference with our money versus that traditional money is that ours is looking for a little bit more risk and therefore a little bit more return. Our dollars are really more a function of a deeper understanding of the market, a deeper understanding of the asset class, and really the broader macro environment, which is why they're leaning into the risk.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owners Association, where real estate investors have found success since 1968. I'm your host, Brian Hamrick from Hamrick Investment Group. This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 424. One of the consequences of the rapid rise in interest rates over the past year and a half has been the difficulty in finding suitable loans for commercial real estate. There's just not enough funds available at terms that pencil out. My guest today is going to help us make sense of the commercial real estate lending options that are currently available and how he's seeing deals getting done in today's environment. He'll also share his perspectives on market cycles in multifamily and commercial real estate. Maxwell Wu is the CEO and co-founder of Fulcrum Lending Corporation, a digital lender for the modern investor. Maxwell has managed and underwritten billions of dollars in commercial real estate. Maxwell, welcome to the show.
Brian, thanks for having me.
Where are you coming from in the commercial real estate lending world?
So Fulcrum Lending, we're solely focused on multifamily. We lend in all geographies. It's called the contiguous 48. Due to our focus exclusively on multifamily, but we've been able to find an edge in the data and the processes that we run that give more competitive quotes, higher leverage than what's predominantly available in the market today. How we started ultimately was from early days in the private lending space and the GSE space, and ultimately grew into a national platform, providing loans, full senior stretch loans, going from 55 LTV all the way up to 80% LTV. Ultimately, where we win most deals is with higher leverage and albeit at a higher rate, but our goal is to be able to provide a better price per pound for our equity investors. In other words, right, really focusing on this cash on cash and being able to deliver those higher returns to their investors.
Obviously, things are very different now. We're in February of 2024 than they were in, say, February of 2022 before interest rates really started taking off. Can you kind of talk about some of the differences you're seeing, particularly when it comes to the multifamily commercial lending?
Today's environment relative to years prior, I mean, obviously the most important is where interest rates are today. Really more reflective and really not as high as where they were in the 80s, right? Where there was just rampant inflation, but also interest rates moving to battle that. Today, there seems to be a lot of people chasing deals still, despite a reset in equity values. And I think it has to do with people taking a longer view, but also maybe some, I don't want to call it delusion, but there's a lot of hope in trying to wait for rates to come back in. Now, it depends what camp you're in, but for myself, truly believe that cap rates do follow interest rates. And then if you are in that camp, you'll see that where the Fed set rates at 5.25%, right? Cap rates should be about 100 basis points wider than that. Today, things are still getting done at 5.5, 6 caps. Where that ultimately sits is and is anyone's best guess. But from our perspective as lenders, really what's most important is what this concept is called as debt yield. And debt yield is basically your NOI divided by the loan balance. And where we are today is, we don't try to set values. We just try to lend responsibly. And how we do that is ultimately setting our own value via this debt yield concept and saying that if we think true value and cap rates are somewhere in the 6 range, right, we're going to want some margin of safety lending on that. That's really been the battle between lenders and investors in understanding where values are. So I think the cash flow based model that we take, cash flow based underwriting that we take, is ultimately something that can at times deliver a lot more leverage, but also in more thinly traded markets can be a more difficult loan to attain. But look, I mean, today there are still deals getting done. It just depends how soon buyers and sellers can kind of meet in the middle.
What you're looking at, you say cash flow based lending. So you're looking at that debt yield, basically how much cash flow is coming in or net operating income is coming in to cover the loan or the debt payment. And given that, because interest rates are higher, there's less net operating income to cover that loan. So one of the battles over the past year and a half has been between sellers who still want values that are up here, and then buyers who are coming in down here saying, well, because of the debt yield, we can't afford to pay these prices up here. Who's winning that battle? And what are you seeing? How are deals getting done and sellers and buyers coming to an agreement on actual value?
Today, right, I think the seller has to be motivated in the sense where there's something holding their feet to the fire, whether it be a maturity coming up on the loan, a amortizing portion of the loan upcoming, or maybe a rate cap burning off. These reasons, right, forcing sellers to sell ultimately drives the price closer to the middle. Where sellers do have some room, right, they will continue to wait. They can afford to wait if they've structured their financing, their capital stack appropriately. But it's really where sellers have a need and buyers can find those deals. This is the other thing too, is that deals are not abound. It takes a lot of work for these buyers to find these deals, and as you know, they're very few and far between. But once they do find someone with a need to sell, right, typically a transaction does get done.
So I'm hearing you say that a lot of these multifamily commercial transactions are need-based. I mean, the seller has a reason they have to sell, because if they didn't, they would probably just be sitting tight and waiting for the market to improve?
Yeah, I think that is the MO right now, is that if you do have time, you're going to wait. Part of real estate is taking a long view, is being patient, is looking into the future and believing in what that market can do, right? We like to finance folks that are local, that understand the market, that have a boots on the ground presence. And with that, they get a unique vantage point and can make a certain call that may make others uncomfortable. But again, there's two sides to every trade. So, we'll wait for that other shoe to drop. So, I don't have a crystal ball, but if there is a reason, a compelling reason to hold, these sellers really are, or would be sellers, I should say, are holding on tight.
Can you give us an example of a recent transaction that sort of typifies what you're seeing in the market right now?
There's some rate caps burning off and sellers are forced to come to the table.
So when you say rate caps burning off, explain to our audience what you mean by that.
So rate cap is what a lender will oftentimes require. Sometimes lenders don't require this, but this is a derivative, a hedge that's purchased by a borrower when they take on a floating rate loan. And that effectively makes the floating rate loan fixed to the borrower, but to the lender, it remains floating. So it's this instrument that allows two parties to get what they want, which are quite opposite to what they need. So the lender can continue receiving an interest rate that rises with the base rate. The base rate's typically SOFR or LIBOR in years past. And the borrower will pay that fixed rate wherever SOFR is, plus that credit spread, and that's going to be their interest rate for however long that interest rate cap is. Typically, these bridge loans are 2 years, so the cap purchase will be 2 years. That being said, there are extension periods for these bridge loans, and you'll have to oftentimes either take on the higher debt service once the rate cap burns off, or buy a new rate cap at a lower strike price. that typically costs a lot of money once the pricing is above where your strike price is.
Are you still seeing the rate caps burning off and then the price of those rate caps spiraling out of control, or have they come back down to earth at all?
Rate caps have come back down to earth. The rate caps are priced based on future movements, right? Where they think interest rates are going to go. So the parties and swaps, right? They are anticipating where interest rates are, and they want to make sure they're getting paid for it. It's a present value calculation. There's some arithmetic there, and encourage your listeners to read into that. But it's arithmetic, and it's a number that's the result. That number, as the actual spot rate goes higher than the strike price where your original loan was, right? Let's say your strike price was at 2% and the at the money strike is at 5% today. You have 3%. You're 3% relatively into the money, which is quite deep. And you're going to have to pay a hefty price to basically save 3% annually going forward. So point being is that going forward, right, 5 seems to be where this ceiling is, 5 and change. It may continue going higher, but really what the markets are saying right now, and this is following discussions from the central bank or the Fed rather, that rates should be coming in this year. Now, everyone has a view on where the rate should be, right? That's always a fun conversation. And if I were to play armchair economist, right, the metrics that we track in terms of health of the economy, one major one driving interest rates, in our opinion, is money supply, or this concept of M2 and money in circulation and free circulation in the economy. And if you look at the amount of money printed, right, over the last 3 years, really since COVID started, about 1/3 of all money in circulation was printed during that period. So, $1 out of every $3 in your pocket just showed up magically. And, folks are using it to buy, capital items, right? Or spend on capital items. But a lot of them are using it for discretionary spending. That's created a lot of inflation. Now, if you take a look at the actual amount of dollars on the sidelines, it is a lot that needs to be sucked out. And the way you suck money out of the system is by raising interest rates. And you raise the interest rates at the central bank, and that should flow through into savings and deposits. But as you've seen, is that banks seem to be the bottleneck right now, because they should be passing on and forcing borrowers to save more by paying them more on their deposits. The only issue is that the money that the banks have their cash, their deposits sitting in 3%, right? And where the prevailing rate should be, let's call it 5 and change, it's hard to suck money out of the system if one of the core mechanisms is a bit broken, that mechanism being banks.
Maxwell, thanks for explaining that. That's really interesting, what you just shared with us. But let's now go back. I interrupted you when you were kind of giving us an example of a typical transaction that you're seeing. Could you please go back to that and give us an example of the type of transactions that you're seeing?
So the typical transaction is when there is a seller in a forced position. As I mentioned, rate cap burning off, an amortizing portion of the loan coming due, or rather an amortizing payment from the interest only period. And the other side is the rate cap side, right? So those are typically what's forcing borrowers to the table. And what we're doing right now is doing a lot of just cash neutral refinances. And the reason our cash neutral refinances work are that we go down to a 1.0 debt service coverage relative to the conventional lending standards of a 1.20 or a 1.25. Our loans are also interest only for the full term. So, this loan that we've created is quote unquote a stretch product, which allows the borrower to take out their current loan at par at a higher leverage point. And that combines a higher cost of funding that gets above or below that 1.20 coverage, I should say. And it does cost a little bit more money, but at the end of the day, being able to preserve value, right? And I think for folks with again, longer term view, they want to hold the property, they want to live off the property. selling the property is really not in their best interest, especially in today's market. So whatever we can do to help salvage or preserve value, we try to. And that's really what our loans do today. And in terms of, again, how much that costs, right? It costs a little bit more than the conventional side because of the leverage. But again, you get to keep the property, you're in control, and you get to wait until rates come back in and markets normalize.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB and Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com. What you just said brings up an interesting distinction I want to make. So typically, if you're buying a commercial multifamily property, you might go to a local bank or credit union. If it's a larger property, there's Fannie Mae, Freddie Mac, and then, insurance lenders, things like that, more traditional or institutional type lending. The type of lending that you're talking about, if I could just generalize, and then you can get more specific for me, we're seeing more and more of that, more of the non-traditional lending that doesn't conform to what a bank or credit union or Fannie Mae or Freddie Mac would require. Can you explain a little bit more about the background of that? Why is that, and how is that possible?
How are we able to get to a 1.0 coverage on our loans?
Where are you sourcing your money from in a way that you're able to kind of change the debt coverage ratio to 1 instead of 1.2 or 1.3, like a lot of banks would require? And then, what is the nature of that funding as opposed to like a traditional institution?
Institutions, right? Your banks, your insurance companies, your credit unions, your really any other REIT, money manager, right? They're highly regulated entities, right? They hold your life savings, they hold your retirement, right? And as such, right, they should be heavily regulated. They should be watched over carefully to make sure they're making the right decisions for their customers, right? They are ultimately serving you, right? One, as a depositor, and making sure that you can dependably store a dollar and get a dollar back whenever you need it is key. Part of doing that is making sure that there are, let's call it, safe lending standards for these banks to ensure that they can hold your dollar and give you a dollar back reliably. The difference with our money versus that traditional money is that ours is looking for a little bit more risk and therefore a little bit more return. Our dollars are really more a function of a deeper understanding of the market, a deeper understanding of the asset class, and really the broader macro environment, which is why they're leaning into the risk. So, we're fortunate enough to have investor dollars that are willing to lean into the market and be able to not only help borrowers and investors preserve their assets and continue operating today, but making sure that they're making a fair return. Because today, if we were lending at conventional standards at a 1.20 or a 1.25, these loans would never be taken out. Borrowers would have to put substantial amounts of cash in. And if you're looking at where debt is pricing today, that equity prices outside of that. So if one is to go raise dollars or take dollars out of their portfolio and reinvest into the asset today, which is from an equity perspective or return on equity, much lower than what they expect, right? It's quite dilutive. So making sure that we're providing accretive solutions for borrowers, for sponsors is important, right? There's two sides to every trade, as I mentioned, and for us to make a loan, there has to be a need. And there's a tremendous need right now for capital to save borrowers and sponsors dollars from putting them back into the property. The other side of being able to lend at a 1.0 is just, again, going back to money supply. And our thesis is, values do have a bottom. There is a fundamental value or creation value to real estate. And again, as more sticks and bricks real estate folks over here that happen to be lenders, we understand that intrinsic value. We understand what that creation value is and can say, this property, the subject property relative to properties proximate to within, 1, 5, 15-mile radius is generating a certain amount of cash that's comparable to the subject property. Expenses are similar, and the cost to build is X, and the cost where, the current investor purchased or where our basis is as lender is inside of where the market is, right? And we'll lean into it. And that number may be much higher than where conventional lenders are because, again, we are taking a more real estate approach to this rather than just looking at it as a vehicle just to generate a small return.
It's very obvious that right now that the institutions and the banks that have to be very conservative and have very conservative underwriting, the terms that they're offering just don't pencil out with a lot of these deals. So you're bringing in alternate capital that can get these deals done. How would you classify the type of capital you're bringing in? Is it private equity? Is it hedge fund money? I mean, where do you place yourself in terms of where your money is actually coming from?
It's private capital, private equity, hedge fund. It's really what we call alternative asset capital, right? Capital seeking alts, structured finance solutions, especially in these volatile times. A structured finance solution or approach is often quite popular in these times of, let's call it dislocation. It allows people to mark values, call values, create a band of returns, a spectrum of returns, if you will, and be able to invest within these bands. That's what we do in the most simple sense is we identify risk within a certain band. We put dollars out and, we evaluate whether we can reliably get a dollar back and get paid for the time our money's out.
Where are you lending, Maxwell? I mean, this is a national podcast. Could anyone listening to this get in touch with you regarding commercial loan on an apartment building?
So we lend across the U.S., all geographies, core urban markets to high growth small markets. We take a top-down approach in selecting these geographies and also a bottom-up approach in understanding what that fundamental value of the asset is or the creation value, if you will. So, with that approach, it makes us quite nimble and allows us to invest very broadly.
And what's your sweet spot? Like what's your minimum, maximum? What type of properties do you actually lend on?
We can lend up to 100, 300 if we really structure it out.
300 million?
Million.
100 million. Okay.
Our smallest loan would be 5 million. We generally like to be in this $5 to $20 million space. We think it's a very underserved market. We believe that there's not enough institutional capital seeking deals within that space. There are very good sponsors within that range. And there are some institutional sponsors that play within that range because of that pricing dislocation there. Once you get into the 20 plus, let's call it $50 million plus transactions, these are incredibly competitive transactions. And oftentimes transactions that, even ultra high net worth individuals can't really even get into. So, again, making sure that we're addressing real problems, real needs in the market, right? And part of that is just identifying where that dislocation is and being able to provide a solution.
Maxwell, how would people find out more about your company or get a hold of you?
You can come to our website, fulcrumlendingcorp.com. You can create an account. We have a suite of investor tools that allow folks to find markets, whether it's a market that they're already successful in or looking for adjacent markets to expand their footprint. We have tools similar to a stock screener that will help you choose markets that are similar to what you know. We also have a market insights and a deal screener to further dig in, understand markets very quickly. And we also have a deal sizer, a deal screener, which allows you to get smart on the deal really quick and understand, again, that fundamental value. We have the ability to provide quotes within 30 seconds on that tool that we have, because we know that it is important that for debt being a lion's share of the capital stack, you need to know how much you can get and how much it costs before you put any bids out, and or even think about how to rearrange your current portfolio. So these are simple solutions that we're creating that make impact.
What is your favorite hack or app?
The calendar app. I follow my calendar religiously. That is ultimately how we're able to do so much in so little time. I mean, organization and process is key, and in the most simple sense, that's what helps me stay on track. I think that's the most used app on my phone, aside from email and calls and texts. I could say our technology that we built, but that's a little bit on the nose.
Maxwell, thanks for coming on the show today and just talking about the state of commercial real estate lending, especially in the apartment world. The options that you are providing in that space, and just the overall view that you've given us of all the different terms that are involved in that space. So thank you very much for having this conversation with us today. It's been a real pleasure.
Absolutely. Thanks for having me, Brian.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's HIG investor.com.